In one single quarter of the year 2000, a company spent $17.1 million on marketing and sales. In that same quarter, it brought in $8.8 million in net sales. That company's sock puppet had already been interviewed by major magazines as if it were a celebrity. It had floated as a 36-foot balloon above the streets of Manhattan at the Macy's Thanksgiving Day Parade. It had just sung "If You Leave Me Now" to tens of millions of people at the Super Bowl. And according to the company's own SEC filings, before the advertising bill was even fully counted, the business was already underwater. This is Pets.com, the company that won the attention economy and lost everything. To understand how this was even possible, you have to go back to what the world looked like before the sock puppet. Not just to 1999, but to the feeling of 1999. Because right now, if you weren't there, it is almost impossible to explain what the internet felt like as a business opportunity in that moment. Every week brought a new company that had gone from idea to IPO in months. A .com name attached to almost anything could pull in millions of dollars of venture capital. Founders were being celebrated on magazine covers before they had shipped a single product. The question was never, does this make money? The question was, how fast can it grow? Venture capitalists in 1999 weren't looking for unit economics. They were looking for market share. Profits were a problem for future you. The assumption, shared by founders, investors, and Wall Street alike, was that if you captured enough attention, the numbers would eventually work themselves out. Spend now. Scale first. Figure out the business model later. That was not just recklessness. That was the prevailing wisdom of the most exciting financial moment in a generation. Into this environment steps a very simple idea. Sell pet supplies online. Americans spend billions of dollars a year on their pets. They buy the same things over and over: food, toys, medicine, accessories, repeat purchases, loyal customers. It sounds almost obvious. The name alone tells the story. Pets.com, domain registered, business plan written, money raised. All that's left is execution. Except, execution is the whole game, and Pets.com was about to learn that the hard way. Greg McLemore is the man who started it. A Pasadena entrepreneur with a habit of registering valuable domain names. Sports.com, Ask.com, Pets.com, and building businesses around them. He registered Pets.com on November 21st, 1994. He launched the site in November 1998 alongside Eva Woodsmall under a company called WebMagic. McLemore had vision. He did not have deep retail experience. And retail, it turns out, is a brutally specific skill. Then comes Julie Wainwright. She is brought in as CEO in early 1999 after a major investment reshuffles the company's leadership. She had previously run Reel.com, one of the early online video retailers. She is smart, she is driven, and in the overwhelmingly male world of late 90s Silicon Valley, she is also one of the very few female tech CEOs in the country. That visibility will matter later, not in a good way. In March of 1999, Amazon announces it has agreed to acquire approximately 50% of Pets.com. Jeff Bezos is all in. Julie Wainwright publicly states, "This is a marriage made in heaven." Amazon's brand and traffic give Pets.com instant credibility. If Bezos believes in this, it must be real. By June 1999, after a $50 million financing round from Amazon, Bowman Capital, and Hummer Winblad, Amazon's stake is expected to rise to approximately 54%. Money is not the problem. Attention is not the problem. Then, someone makes a sock puppet. TBWA Chiat is the San Francisco ad agency brought into brandpets.com. These are the same people who created the Taco Bell Chihuahua. Creative director Rob Smiley helps lead the effort. The brief isn't to build something polished or corporate. The vision, as Smiley later described it, was to build a whole world. One where Pets.com genuinely understood animals on their own terms. In his words, we started to create a world where we showed that Pets.com understood that pets have lives. They have things they love. They have things that make them sad. What that world produced was a deliberately strange mascot, not sleek, not aspirational. They build a homemade-looking sock puppet, a Timex wristwatch for a dog collar, button eyes, a cardboard microphone with the Pets.com logo stuck on the side. Smiley later described it as slapdash. That was entirely intentional. The mascot is voiced and physically performed by Michael Ian Black, then best known from the MTV sketch comedy The State. Black later admitted the role was physically painful, his arm raised inside the puppet for extended takes on set. The puppet was widely known simply as the Pets.com sock puppet, so every time people talked about the mascot, they repeated the company name. The tagline was equally simple, because pets can't drive. In total, the company would spend approximately $20 million on the sock puppet campaign. And here is where the story starts to split in two, because the puppet is about to become one of the most famous advertising characters of the dot-com era, and the company behind it is about to collapse. In its first operating year, from February to September 1999, Pets.com generated $619,000 in total revenue. It spent $11.8 million on advertising in that same period. Let that math sit for a moment. $600,000 in revenue. $11.8 million in ads. The sock puppet is already running in national television spots. And Oscar Yuan, an assistant marketing manager inside the company at the time, remembers what customers were actually calling about. I remember the customer service was fielding inquiries all the time for people, like, "Can I get a puppet? Can I get a puppet? When is the puppet going on sale?" Customers loved the puppet. They wanted to buy the puppet. They did not especially want to buy 40-pound bags of dog food through a website. Meanwhile, a rival company called Petopia.com was reportedly receiving customer messages praising the Pets.com sock puppet. The brand was working. The business was not. In Q4 of 1999, Pets.com spends $30.7 million on marketing. That is nearly 6 times its quarterly revenue. The puppet floats through the Macy's Thanksgiving Day Parade at 36 feet tall. It appears on Good Morning America, on Live with Regis and Kathy Lee, on Nightline. Time, People, and Entertainment Weekly treat it like a sentient celebrity. And then comes January 30th, 2000, Super Bowl 34. One of the most watched television events of the year, with an audience reported around 88.5 million viewers. The sock puppet appears on screen and sings "If You Leave Me Now" by Chicago. The ad reportedly cost Pets.com somewhere in the 7 figures, with some accounts placing the spot around $1.2 million. The performance is charming, ridiculous, and completely impossible to ignore. 12 days later, on February 11, 2000, Pets.com goes public on the Nasdaq under the ticker IPET. IPO price, $11 per share. The offering raises approximately $82.5 million gross, around $75.3 million after underwriting and offering costs, according to the company's own SEC filings. Market cap at IPO, approximately $290 million. The stock briefly touches $14, and then something happens that no one at Pets.com could control. On March 10th, 2000, 30 days after the IPO, the Nasdaq Composite peaks at 5,048, and then it starts to fall. Here's what that means, because it matters enormously to what comes next. The Nasdaq Composite is the stock market index that tracks technology and growth-oriented companies. Through the late 1990s, it had been on an extraordinary run, climbing year after year as investors poured money into anything with a .com attached to its name. That peak at 5,048 wasn't just a number on a screen. It was the moment the entire logic that had made companies like Pets.com possible snapped. The venture capital money that had been flowing into unprofitable businesses, on the promise that profitability was always just one more funding round away, started to dry up. Investors who had been happy to fund growth stories at any cost began asking the questions they had been skipping for years. What do you actually earn? When do you actually break even? How does this actually work as a business? Pets.com did not have good answers. The crash doesn't announce itself with a single dramatic moment. It bleeds, slowly at first, then faster, then all at once. The capital markets that had been funding unprofitable companies on the promise of future scale begin to close. Investor appetite for .com stocks curdles almost overnight. Pets.com is now a publicly traded company. It has to file quarterly reports, and those reports are about to tell a story that the Super Bowl ad could not hide. In Q2 of 2000, Pets.com's first full calendar quarter as a public company, the SEC filing shows $8.764 million in net sales, $10.513 million in cost of goods sold. That's a negative gross margin before a single dollar of marketing is counted. Then add $17.091 million in marketing and sales expense. Omar Merlot, a marketing professor at Imperial College London who later analyzed the campaign, put the number plainly. The cost to acquire one customer at Pets.com was approximately $400. The average order value was about $37. You are spending $400 to acquire a customer who spends $37. And only about half of those orders even include pet food. Wainwright later pushed back on the simplified version of this story, the one that says, shipping heavy pet food killed them. She was right that it was more complicated than that. But more complicated doesn't mean better. The SEC filings don't lie. For every dollar in sales, Pets.com was losing money before the advertising bill even landed on the table, and the advertising bill was enormous. By the end of Q3 in 2000, some numbers are improving. Net sales climbed to $9.4 million. Gross margins are still negative, but less so, improved from negative 20% to roughly negative 3%. The company is burning less cash on marketing, about $14.7 million that quarter, down from $17.1 million. But even as those internal numbers edged in the right direction, the company was still betting on scale. In June 2000, Pets.com announced an all-stock deal to acquire key assets of PetStore.com, valued by contemporary reports at about $13.5 to $13.7 million, with an additional $3 million cash investment tied to the transaction. They are doubling down, betting that more customers and more reach would fix what the unit economics couldn't. It wouldn't. The sock puppet itself also becomes retail merchandise in 2000. A talking retail version begins shipping on June 13, 2000, priced at $20. More than 10,000 sell in the first week, and by late July, more than 35,000 physical sock puppets have been sold. The stock has fallen below $1. The Nasdaq is in freefall. And Wainwright later said publicly what the internal math had already shown. Pets.com needed approximately $260 million to reach profitability. It had raised approximately $180 million. The remaining capital was not coming. Not in this market. Not anymore. On November 7, 2000, Pets.com announces it is shutting down. 255 of the company's 320 employees are laid off the same day. The company announces it will stop taking orders on November 9th. SEC filings later described the website closure and cessation of sales transactions as effective November 10, 2000. Total time from IPO to shutdown announcement, about 270 days. The stock that opened at $11 closes around $0.19. Shareholders receive 9 cents per share back, a 99.2% loss. Nearly $300 million in public market value evaporated. Around 570,000 customers had active accounts at the time of shutdown. They log on one day, and the site simply isn't there anymore. Wainwright's shutdown statement is measured and careful. It is well known that this is a very, very difficult environment for business-to-consumer internet companies. With no better offers and avenues effectively exhausted, we felt that the best option was an orderly wind-down, with the objective to try to return something back to the shareholders. The Wall Street Journal would later call it the poster child for internet bubble excesses. The aftermath for Wainwright personally is brutal. She later reflected, "I became sort of a pariah. I was like the dumbest person in the valley, and it was a little tough." She describes being effectively unemployable after the collapse, noting with some bitterness that the tech world's famous embrace of failure is largely theoretical. No one wanted that one failure. That sounds like a really great thing to do, but no one likes to lose money. She eventually founds The Real, a luxury consignment marketplace, which goes public in 2019. One of the great second-act stories in Silicon Valley history. But that takes years. In December 2000, PetSmart quietly purchases the Pets.com domain. The price is not publicly disclosed in the core records most often cited. The domain later redirects to PetSmart. In 2002, a subprime auto lender called Bar None, along with Haycon and Associates, acquires the rights to the sock puppet for $125,000. Their new slogan, "Everybody deserves a second chance." At Super Bowl 35 in 2001, just 1 year after the famous sock puppet ad airs, E-Trade runs a commercial showing a chimpanzee riding through a ruined .com landscape, watching a building labeled esocks.com get demolished, then weeping as a discarded sock puppet lands at his feet. The .com failure has become a Super Bowl punchline, and then, the strangest twist of all. In 2019, a company called Chewy.com goes public. Online pet supplies, direct-to-consumer, repeat purchases, the exact model Pets.com tried to build. In fiscal year 2025, Chewy reports net sales of $12.6 billion. $12.6 billion. The idea was never wrong. Here's what this story is actually about. It is not really about a sock puppet. The sock puppet did its job. Rob Smiley and the team at TBWA Jaya Day built something genuinely iconic. Decades later, people still remember what that puppet looked like. That's not failure. That's a creative triumph. The failure was the assumption that brand fame and business viability are the same thing. They are not. They have never been. And in 1999, the entire .com era convinced itself otherwise. Profits didn't matter. A functional business model was, as one NPR source put it, just like an afterthought. As long as you were growing, as long as you had mindshare, as long as VCs kept writing checks, you could defer the question of whether the numbers actually worked. But the numbers don't defer. They just wait. When only 41.5% of U.S. households had internet access in the year 2000, when cheap, efficient shipping infrastructure was still a decade away, when consumers weren't yet conditioned to buy 40-pound bags of pet food from a website, no amount of Super Bowl ads was going to close that gap in time. Chewy didn't invent a new idea. Chewy just showed up when the infrastructure caught up to the vision. Pets.com was not dumb, it was early, and in business, being early is often indistinguishable from being wrong. Until suddenly, it isn't. The sock puppet became famous. The company had not become viable. That gap between fame and viability is where nearly $300 million in public market value evaporated. That is the story of Pets.com. About 270 days from Wall Street, darling, to gone. If you've ever wondered how a company can be this famous and this broke at the same time, now you know. If you found this story fascinating, like and subscribe, and don't forget to hit the bell. Thanks for watching AMPVEX. We'll see you in the next one.